Today, we're going to break down 3 huge signals that are reshaping the world of finance as we speak, from what the central banks are doing to the moves being made in digital money.
All right, let's jump right in. The big news: the Fed just cut rates again. And you're probably wondering, okay, what does that actually mean for my money? Well, it could hit everything from your credit card to your savings account.
So, first up, let's talk about that Fed rate cut. It might seem like just a small tweak to their policy, but believe me, a decision like this sends some serious ripples across the whole economy. So what are we looking at here? The Federal Reserve just made its 3rd rate cut in a row, pushing the benchmark rate down to around 3.5%. But, what does a number like that actually translate to in the real world? Okay, but what's really interesting is when you zoom out and look at the bigger picture. This cut brings the rate to the lowest it's been in almost 3 years. And as you can see on this chart, it's not just a one-off thing. It's part of a clear trend. The message is simple. Borrowing money is getting cheaper. So let's get down to the nitty-gritty. How does this actually affect you? Well, 3 big ways. First, good news for borrowers. Things like mortgages and car loans could get cheaper. Second, not so great news for savers. The interest you earn in your savings account, that's probably going down. And third, looking at the big picture, a rate cut like this is often seen as a signal that the Fed might be worried the economy is slowing down. Okay, so that's signal number 1. Now let's pivot and talk about our second signal, because we're shifting from the world of traditional central banks to digital assets. And while all the headlines are screaming about price swings, there's a much quieter and maybe more important story happening in the background. Yeah, if you just look at the daily price of Bitcoin, you might think things are a little shaky, a little cautious. But that's just the surface noise. If you look deeper, underneath all that volatility, you'll see a really interesting pattern emerge. Big institutional money is getting involved. And this chart right here, it tells that story perfectly. We're looking at regulated investment funds, ETFs, the same kind of thing you might use to invest in stocks. Well, these crypto ETFs have just seen their biggest weekly cash injection in a while. So big money is flowing into Bitcoin and Ethereum, but it's doing it through these buttoned-up traditional investment channels. And this is the key takeaway right here. We're not talking about day traders trying to make a quick buck. This steady flow of cash into regulated funds points to something much bigger, a long-term belief from major institutions. They're integrating crypto into the financial system for the long haul. And what's wild is that this is all happening just as governments are starting to pay serious attention. Which brings me to our next point. Coming right up, we're going to talk about why stablecoins are suddenly being treated like regular money. All right, so for our third and final signal, let's talk about regulation. Because as crypto goes more mainstream, you can bet governments aren't just going to sit on the sidelines anymore. Oh no, they're jumping in and actively writing the new rules of the game. And a huge focus for these new regulations, it's something called stablecoins. Now, if you're not familiar, they're exactly what they sound like, digital tokens that are designed to be stable. How? They're pegged to a real-world currency, like the US dollar. So regulators are looking at these and seeing them as a kind of bridge between the old and new financial worlds. And they want to make damn sure that bridge is safe to cross. And this isn't just happening in one place, it's a global thing. Take Canada, for example. They're all about protecting the consumer. They're saying, hey, if you're gonna issue a stablecoin, it has to be backed one-to-one by real cash or something just as safe. Then you look over at the UK, and they're going even bigger. They're building a whole framework to make crypto companies play by the same rules as traditional banks. Now, look, this stuff doesn't happen overnight, but we are getting a really clear timeline. By 2026, we're expecting Canada's new rules to kick in, and the UK will be locking in its own regulations. Then, by late 2027, the UK's whole system is set to be live. And this kind of clarity is exactly what those big institutional investors we were talking about have been waiting for. Okay, so let's take a step back and connect the dots. We've got 3 huge, seemingly separate things happening. The Fed is making money cheaper, big institutions are buying up digital assets, and governments are creating rules for it all. So, what does it all mean when you put it together? Well, when you line them all up, you see this incredible convergence happening. On one hand, you have central banks loosening the reins on traditional money. At the same time, you've got the big players in finance seriously adopting digital assets, and wrapping it all up is a new global rulebook being written in real time. This isn't just 3 random headlines, folks. This is basically the blueprint for the future of finance, a future where the line between traditional and digital money gets really, really blurred. And that convergence just leaves us with a huge question, doesn't it? As these 2 worlds, the old money and the new money, keep merging, what's the next shoe to drop? What's the next big signal we should all be watching for? Because if you understand these trends today, you're going to have a much better handle on what the world of money looks like tomorrow.